Okay, so this is the Federal Reserve Week, and I don't know if you're anything like me, but man, I love talking about the Federal Reserve. So I'm excited for this week. I apologize, someone's mowing the lawn outside, so hopefully you can hear me. All work for this week is going to be due at 11:59 on Sunday, June 5th. Note that your lesson plans, your inflation lesson plans, are also due on June 5th. If you need, I realize now that you're probably finishing classes around this time. So if you need extra time on that, it's really not a big deal. Just make sure you talk to me. Okay, so I'm just going to start with a monetary policy primer. I've got a link here. I'm not going to bother to play it for you. You might be interested in it. Your students might actually like it. It's about, the origins of the Fed. It's from Planet Money. But I'm just going to go through it because I don't know how much you know. And hey, I love teaching the Fed, so why not, right? So the Fed is our central bank. There's two functions. The first is to control the supply of money. That's monetary policy. That's the part I care about. And the other part is to regulate banks. It was established in 1913 through the Federal Reserve Act. We had two central banks prior to this. Some of you are history teachers. You know this more than I do. Those were wildly unpopular. This one has stuck. So the monetary policy part is made up of the Board of Governors. This is 7 members that are appointed by the President and approved by Congress. They are appointed to 14-year terms intended to insulate them from political pressure. I say it all the time, the Federal Reserve is not political. It should never be political. The Fed does the very unpopular job of raising interest rates to combat inflation. I don't want to be voting on these people, right? The chairman is voted on every 4 years. You probably know Jerome Powell. Before him, it was Ben Bernanke and Janet Yellen, and before them, it was Alan Greenspan, and before him, it was Paul Volcker. Like I say, it's not political. So Jerome Powell was appointed by Trump, reappointed by Biden. The only time it's ever been political is when President Trump got rid of Janet Yellen because he wanted his own appointee, who was Jerome Powell. Janet Yellen is currently our Treasury Secretary, though, so she's doing just fine. And Jerome Powell is doing what I believe a Democratic Federal Reserve chair would do anyway, because it's not political. So the Open Market Committee is made of the Board of Governors plus 5 regional presidents. 4 of these rotate, and one is always the New York Federal Reserve president. So these are the people making monetary policy decisions. So the Federal Open Market Committee is the group I care about. In addition, there's 12 regional banks. The job of these is to audit the books of banks and to provide banking services. So I always like to tell students, do you have a dollar bill on you? And they pull out a dollar. You can look on a dollar and it will say which Federal Reserve bank owes you the dollar. And that's always kind of fun. And then one of my professors as an undergrad would always say, he'd make the same joke every time and I loved it. He'd say, "This is all my wife would give me today." So there's that. All right, so the Federal Reserve is very obsessed with something called the dual mandate. And this is from the Federal Reserve website. The Congress established the statutory objectives for monetary policy: maximum employment, stable prices, moderate long-term interest rates in the Federal Reserve Act. So when you read a statement by the Open Market Committee, which you would have done last week, you'll see that they talk about the dual mandate. Hey, we can't control the debt. We can't control taxes, right? This is our job. This is what we're focused on, the dual mandate. Low unemployment, stable prices. And are these competing goals? Yes, they are in the short run. All right, so then we need to back up and say, well, how is money created? So if the Fed is controlling the supply of money, let's think about how it's created. And it's created through loans. And some of you probably teach this and you teach it better than I'm going to, but I do think it's worth going over if it's been a while for you. So suppose that Mary finds $1,000 under her mattress. She deposits it into Fred's bank. Fred's bank then wants to loan part of that out. So why do banks want to loan out their money? To make money. Banks make money on loans. The Federal Reserve says, hey, Fred, you can't loan it all out. You can't lend out all of Mary's $1,000. You have to put some in the vault. So he must put, say, 10% of it in the vault. So what happens then is Fred's bank balance sheet has assets and liabilities. The assets are $900 in a loan to someone named Jennifer, and $100 in the vault. And then the liabilities is $1,000 that Mary, sorry about the formatting, Mary can take out whenever she wants. So the bank owes Mary her $1,000. That's her money. But it's taking that and it's making a loan. Okay. So Jennifer, she just got a $900 loan. She would probably spend it at some point, but at least at first she's going to put it into Carla's bank. So Carla takes that $900. She has to put 10% in the vault. She's going to lend the rest of it out. Okay, so we've got Carla's bank balance sheet. She loans out $810 to Steve, puts $90 in the vault. Her liabilities is $900 to Jennifer. So basically, this is going to continue on and on and on. So the initial $1,000 that Mary found under her mattress becomes at least $2,710 plus future stages. I must have done a few stages when I made this. This is called the money multiplier. So loans multiply into more money. So you don't really have to understand this, but the point is loans equals money. So when the Federal Reserve wants more money, it's encouraging loans. Another thing is banks are playing this weird balancing act, right? So my professor with the dollar used to call it legalized gambling. So basically, Fred can't pay all of its depositors. Fred's bank can't pay all of its depositors at once. So Mary could come back and be like, hey, I want my $1,000. Fred doesn't have it, right? He's lent out $900. So it's this balancing act. And in fact, if they can't pay, that's called a run on a bank. We've got some things in place in this country so we don't have to worry about runs on banks. One of these is FDIC, Federal Deposit Insurance Corporation. If you go to a bank, you'll see that on the window, FDIC insured. Our deposits are insured up to $250,000 in this country. It was actually raised like quietly in the middle of the financial crisis. It used to be $100,000. So that's like this balancing act they do, right? And so a lot of the Fed's tools are changing these incentives. So that's why I love teaching it. It's really cool. All right. So monetary policy. If you increase the supply of money, what that does is it increases the supply of loanable funds, which decreases interest rates. If you decrease the supply of money, it decreases the supply of loanable funds and increases interest rates. This is something I taught my first time I taught macro in 2008. I just didn't find the costs were worth the benefit, or the benefits were worth the costs. So I don't like draw the supply and demand of loanable funds. But you could do it if you were interested in it. So more money decreases interest rates. All right. Expansionary policy. Expansionary policy has a goal of increasing the supply of money while keeping an eye on inflation. So this is one thing that the Fed does sometimes is expansionary policy. How would it do this? By incentivizing loans. So again, banks take deposits and make loans. Loans are greater than deposits. If banks make more loans, there's more money in the economy. So I'm going to focus on the expansionary policy. I don't know, I just think it's more intuitive. But clearly what our Federal Reserve is doing right now is contractionary policy. So contractionary policy would be fewer loans. More loans expansionary, fewer loans contractionary. All right. When I learned this, which was in 2004, my professor taught me this. The Federal Reserve has these tools. Reserve requirements, the federal funds rate, the discount rate, and open market operations. He actually said there was a fifth tool called persuasion. This is how I learned it, and this is maybe how some of you guys learned it. What happened is the financial crisis came along. Mr. Ben Bernanke, who by the way is one of my favorite economists of all time, Ben Bernanke was like, we need some new tools, so he introduced some new tools. And what we're focusing on in the economics of COVID is Mr. Jerome Powell, who said, COVID hit, we need even more tools. Okay, so I'm going to start with these traditional tools, and then we're going to kind of talk about what's changed. So the first is reserve requirements. So banks must keep 10% of deposits in the vault, usually. And so expansionary policy would be to decrease it. Hey banks, don't worry about it. You can put less money in the vault. Loan more out. Contractionary policy would be to increase this. Hey banks, you got to put some in the vault, stop loaning so much. So what I would encourage you guys to do is actually pause this and Google, if you don't already know, what our reserve requirements currently are. Okay, so hopefully you did Google it. And by the way, this is something that I like to do in class a lot, is I'll have the students Google stuff. They have their phones on them anyway. Because it's like a lesson. Hey, which one do I click on? Do I click on Wikipedia or federalreserve.gov? I clicked on federalreserve.gov, and man, look at this. What is our current reserve requirement? 0. Okay, so banks are like, they don't have to put any money in the vault. That is incredibly aggressive expansionary policy. Okay, and that happened in the middle of COVID. The Federal Reserve was like, hey, don't worry about it, lend it all out, which to me was really interesting. All right. One of my favorite things I know about all of economics is the federal funds rate. And I'm sure you guys know about it, but when, you know, the people say, oh, the Fed raised rates, the Fed dropped rates. Excuse me. I think people think that the Fed is like directly impacting car loan rates and stuff like that. No, it's not. It's this really obscure little rate. So the federal funds rate, the Fed actually sets a target for it. It's determined in the open market. Open market. But basically, this is the interest rate banks pay for screwing up. Okay, so think about the Fred's Bank. Fred's Bank had lent out all this money, and it couldn't pay back the original person. I think it was Mary whose money it was. Mary wants her money back. Fred's like, oh my God, I don't have it. So Fred's basically got two options. Can't pay its depositors. Number one, it can borrow money from another bank. And number two, it can borrow money from the Fed. And these are overnight loans. These are short-term loans. The federal funds rate is the interest rate banks pay to borrow from other banks. So if Fred's bank borrows from Carla's bank, that's the rate they pay. So if it's low, it means it's cheap to make a mistake. The Federal Reserve is sending the signal, hey guys, lend a lot. There's very little penalty for lending, more loans, more money. Expansionary policy. High rate, it's costly to make a mistake. Maybe don't loan so much out. Let's drop the amount of loans made. And in fact, what is our federal funds rate? Well, let's see. Today is Monday, May 9th. It was just raised last week. It was just increased by half a point. And so actually, I think I have it on the next slide. Let's take a look together. And what happened when the Fed raised that rate is the markets freaked out, which is very annoying to me, right? Because the Fed's been saying, hey, we're going to raise rates 7 times this year. And when it does, the markets are like, oh my God, no. So the Fed has set a range between 0.75 and 1. Prior to last week, it was a range between 0.25 and 5. So that was actually a pretty big increase. It was a half-point increase, which is like historically very large. And the reason the Fed is doing this is because of inflation. You can actually pull up our handy Fred chart on the federal funds rate. Students tend to like this one. And you can see what happens to the federal funds rate over time. And what happens is when we're in a recession, the federal funds rate gets cut, 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 cut. When we're in an expansion and worried about inflation, that's when that increases, and it's increasing right now. So I'm at 14 minutes on the screencast-o-matic thing. So what I'm going to do is I'm going to stop. Maybe a good thing to do while you go on to the next one is to actually look up the daily federal funds rate. So it is a range. So it is a range between 0.75 and 1. And so this is actually in PowerPoint that I posted if you want it. You can see that yesterday it was 0.83. So it fluctuates within the range. You can see the day that it was raised, the 5th. All right, so I'll start up next with the discount rate.